the shockwave nobody is pricing in. Traders call it stability bias. Investors assume that even when tensions rise, rational actors will step in, de-escalate, and protect the system. But history shows something far more dangerous. The most devastating market collapses, Dante, come from expected crises. They come from the moment when an unthinkable event actually happens. A direct U.S. strike on Venezuela would be one of those moments. On the surface, Venezuela might look like an isolated, already broken economy. Hyperinflation, sanctions, political chaos. Markets believe the damage is already priced in. That belief is dangerously wrong. Venezuela is not just another struggling nation. It sits on the largest proven oil reserves on Earth, its energy infrastructure. Trade routes and political alliances connect directly to the deepest pressure points of the global financial system. A U.S. strike would not be local. It would be systemic. The first shock would hit energy markets instantly. Oil is not just a commodity. It is the bloodstream of the global economy. Any military action involving Venezuela would immediately raise fears of supply disruptions, shipping blockades, sabotage, and retaliatory action across Latin America and the Caribbean. Even the expectation of instability can send oil prices surging within hours. Algorithms don't wait for confirmation, they react to headlines. Futures spike, volatility explodes, and liquidity evaporates. But the real danger lies in how energy shocks cascade. Higher oil prices feed directly into transportation costs, manufacturing, food prices, and electricity generation. Inflation, which many economies are already struggling to contain, would roar back with renewed force. Central banks trapped between slowing growth and rising prices would face impossible choices. Rate cuts would fuel inflation. Rate hikes would crush debt-heavy economies. Either path destabilizes markets, equities would not be spared. Global stock markets are priced for a world where supply chains, energy flows, and shipping lanes remain functional. A U.S. strike on Venezuela would introduce a new category of risk: geopolitical contagion in the Western Hemisphere. Investors would begin questioning which countries might be next. When uncertainty rises this fast, markets don't rotate, they flee. Capital would rush out of Latin America, not because every country is at risk, but because fear does not discriminate. Currencies would weaken sharply. Dollar demand would surge. Sovereign bond yields would spike as investors demand higher compensation for risk. Governments already stretched thin by debt and social pressure would suddenly face funding crises. Yet even developed markets would not be safe. U.S. stocks, often seen as a haven, are deeply exposed to global instability. Multinational corporations rely on predictable energy costs, stable shipping, and functioning foreign markets. A prolonged oil shock combined with geopolitical escalation would hit earnings forecasts hard. The result would not be a slow correction, but violent repricing. Trillions of dollars in contracts are built on assumptions about interest rates, commodities, and volatility staying within historical ranges. A sudden oil spike and global risk-off move could break those assumptions overnight. Margin calls would surge. Forced liquidations would accelerate sell-offs. What begins as a geopolitical event quickly becomes a financial chain reaction. The 1973 oil shock reshaped global markets for a decade. The Gulf War sent energy prices soaring despite limited physical damage. Even smaller regional conflicts have triggered worldwide sell-offs. But today's system is far more leveraged, faster, and interconnected than ever before. Algorithms amplify panic. Social media accelerates fear. Capital moves at the speed of milliseconds, not days. Another overlooked factor is retaliation, not necessarily military, but economic and political. Venezuela's allies would not stand aside quietly. Energy partnerships, trade agreements, and strategic cooperation could shift rapidly. Markets hate uncertainty more than bad news. And a sudden realignment of alliances would create uncertainty on a scale few investors are prepared for. Perhaps the most dangerous illusion is the belief that markets can bounce back quickly. Short-term rebounds often mask long-term damage. Once trust is broken in energy stability, in geopolitical restraint, predictable policy responses, risk premiums stay elevated. Investment slows. Volatility becomes the new normal. The system doesn't collapse in a single day. It corrodes over years. This is why a U.S. strike on Venezuela would not just be another headline. It would challenge the core assumption holding global markets together, that major powers will always avoid actions capable of destabilizing the entire financial system. If that assumption breaks, everything must be repriced. And this is only the first layer of the crisis. Beneath it lies something even more dangerous. A geopolitical domino effect that could redraw global power lines and permanently alter how markets function. The geopolitical domino that could shatter markets. When financial markets experience sudden shocks, the initial moves are obvious. Oil spikes, equities tumble, and investors flee to perceived safe havens like gold or the US dollar. But what most analysts fail to account for is the domino effect, the cascading geopolitical consequences that ripple through economies and disrupt markets in ways no chart or model can fully predict. A US strike on Venezuela wouldn't just be a regional skirmish. It could set off a chain reaction that destabilizes Latin America, strains Europe and Asia, and undermines global trade networks. The first domino falls in Latin America itself. Venezuela's neighbors, including Brazil, Colombia, and Guyana, are tightly interconnected through trade, energy, and investment flows. Any U.S. action is bound to raise alarm across the region. Governments would be forced to take sides, reassess alliances, and potentially restrict foreign investment to shield themselves from fallout. Investors, seeing heightened political risk, would pull capital from entire markets, not just Venezuela. Currency volatility would surge, and local stock markets would experience unprecedented swings. For economies already grappling with inflation or debt, this could trigger financial crises overnight. Energy is the immediate pressure point. Venezuela holds roughly 300 billion barrels of proven oil reserves, more than Saudi Arabia. Although production has fallen due to mismanagement and sanctions, even a fraction of these reserves moving off the market or threatened by conflict would send global oil prices soaring. Gasoline, diesel, and jet fuel costs would spike worldwide, hitting households and businesses alike. Transportation-dependent sectors, airlines, shipping, logistics, and manufacturing, would feel the pinch immediately. The ripple effects would extend to commodity markets, raising prices for goods ranging from plastics to fertilizers, since many rely on oil as a feedstock. But the energy shock is only the beginning. Military action carries the risk of sabotage, infrastructure damage, and retaliatory cyber attacks. Venezuela has cultivated alliances with countries like Russia, China, and Iran. These nations could respond indirectly, targeting supply chains, commodities trading platforms, shipping routes in retaliation. Even without a full-scale conflict, the threat of interference would heighten risk premiums across global markets. Shipping insurance would skyrocket, freight costs would climb. Importers and exporters would scramble to secure alternative routes, slowing trade and increasing uncertainty. Financial markets are uniquely sensitive to uncertainty. Unlike physical goods, money moves at light speed. Algorithmic trading and high-frequency systems react to news within milliseconds, often exaggerating price movements. A report of a U.S. strike, or even a credible rumor, could trigger automated sell-offs in equities, currencies, and commodities simultaneously. Margin calls would cascade through investment funds, forcing further liquidation. Hedge funds, banks, and pension funds would be compelled to adjust portfolios rapidly, amplifying market turbulence. What begins as a geopolitical event can instantly morph into a systemic financial crisis. The European Union, though geographically distant, would be drawn in almost immediately. Many European economies rely on stable oil prices for energy-intensive industries. Higher fuel costs would exacerbate inflation, forcing central banks to choose between slowing growth with higher interest rates or accepting runaway prices. At the same time, Europe imports Venezuelan oil indirectly through intermediaries and contracts. Supply disruptions would add pressure to already strained energy markets, particularly in countries transitioning away from Russian gas. Politically, EU nations would face internal divisions, with member states debating responses to U.S. military action, potentially weakening European cohesion at a critical moment. Asia, especially China and India, would also feel the tremors. China has invested heavily in Venezuela through loans, oil for infrastructure deals, and joint ventures. A military strike could jeopardize these projects, sparking losses for Chinese state-owned enterprises. India, heavily reliant on imported oil, would see energy costs surge, pressuring domestic inflation and government subsidies. Both nations would have to navigate a delicate balance between condemning intervention, protecting economic interests, and avoiding direct confrontation with the U.S. Markets would interpret any hesitation or political friction as instability, pushing global risk premiums higher. Then comes the financial domino, the hidden web of derivatives, swaps, and credit obligations that underpins modern markets. A sudden spike in energy prices combined with political uncertainty would disrupt assumptions baked into these contracts. Banks would face exposure on credit default swaps, futures contracts, and corporate loans linked to volatile sectors. Forced adjustments would ripple across global financial institutions, raising the specter of liquidity crises. Unlike a normal recession, which develops gradually, this type of shock spreads through systems almost instantaneously, leaving little room for intervention. Commodity markets beyond oil would also react. Venezuela's instability could threaten mining operations, agriculture, and key exports in neighboring regions. Copper, gold, and nickel prices could spike due to supply concerns. Food prices could surge if transportation routes are disrupted or if neighboring countries restrict exports to preserve domestic supply. Emerging market economies dependent on commodity trade would face twin pressures of inflation and weaker currencies, potentially triggering sovereign debt crises that echo far beyond Latin America. The human factor cannot be underestimated. Conflict triggers mass migration. Millions could flee Venezuela and other at-risk countries, placing stress on social infrastructure in neighboring nations. Refugee flows could exacerbate political tensions, disrupt labor markets, and strain public finances, especially in countries already coping with fragile economies. Markets dislike unpredictability in demographic and labor flows, because it complicates long-term planning for investment and policy. Perhaps the most dangerous element is perception. Modern financial systems are not only about fundamentals but also confidence. If investors perceive that the U.S. is willing to intervene militarily in Latin America, it changes expectations permanently. Markets could start pricing in higher geopolitical risk premiums, not just for Venezuela, but for other politically unstable regions worldwide. Trust in the predictability of international relations, a foundation of global finance, would erode. Even minor skirmishes or sabotage could escalate into cyber attacks on critical infrastructure, from energy grids to financial networks, far beyond Venezuela. The financial sector, already reliant on digital systems, would be vulnerable. Cyber disruptions in payments, trading platforms, or banking networks could amplify market panic, creating feedback loops of uncertainty and forced liquidation. Finally, geopolitical escalation could create a permanent restructuring of alliances. Nations forced to choose sides might establish parallel financial systems, trade networks, or currency arrangements to bypass U.S. influence. Over time, this fragmentation would reduce liquidity, increase transaction costs, and weaken the global financial architecture. Markets are deeply sensitive to fragmentation because they thrive on predictable rules and interconnected networks. Once those networks are disrupted, volatility becomes the default state, making sustained growth far more difficult. The financial tsunami no one is ready for. By now, the initial shocks from a U.S. strike on Venezuela would already be reverberating across the globe. Oil prices would have spiked, stock markets would be in free fall, and investors would be scrambling to secure capital. But what most analysts overlook is the long-term systemic tsunami such an event would trigger a series of financial, economic, and political consequences that could reshape the global marketplace forever. This isn't just a temporary correction. This is a structural upheaval, one that the world's financial institutions are ill-prepared to handle. The first wave of this tsunami hits the banking system. Banks are interconnected through a complex web of loans, derivatives, and cross-border exposures. A sudden spike in energy prices, combined with political uncertainty in a resource region, would trigger massive volatility. Companies with exposure to Venezuela or Latin America would begin to default on loans, triggering margin calls and forcing banks to liquidate other assets to cover losses. This fire sale would ripple through global markets, amplifying losses far beyond the original shock. Even banks in Europe and Asia, distant from the epicenter, could find themselves under severe stress. As interconnected systems transmit financial shocks faster than ever before, credit markets would be the next casualty. Investors, suddenly wary of geopolitical risk, would demand higher yields for lending to emerging markets. Sovereign debt from countries in Latin America and beyond would suddenly appear far riskier, increasing borrowing costs and putting additional strain on already fragile economies. Corporations reliant on imported energy or trade with Latin America would face skyrocketing costs. Project financing for infrastructure, energy, and manufacturing would slow to a crawl. Capital would freeze in regions most vulnerable to the fallout, further destabilizing economic growth. Meanwhile, commodities beyond oil would see unprecedented volatility. Venezuela is a critical hub not just for oil, but for strategic minerals and metals. Disruptions to extraction or transport would ripple through global supply chains, driving prices for essential raw materials higher. Industries like technology, manufacturing, and agriculture, all reliant on stable commodity prices, would be forced to recalibrate. Inflation, already a concern in many economies, would spike across the board, eroding purchasing power and increasing social tension. Governments might impose price controls, export restrictions, or other emergency measures, which could create further inefficiencies and exacerbate market instability. Global equity markets would experience a multi-layered collapse. Algorithms would exacerbate volatility, as automated trading systems interpret the geopolitical event as systemic risk. This could lead to rapid sell-offs across sectors that appear indirectly exposed, from energy and commodities to consumer goods and tech. Investor sentiment would deteriorate rapidly, with risk appetite evaporating almost overnight. Even traditionally safe equities could come under pressure. As the interconnectedness of global supply chains and financial systems transmits panic worldwide, a temporary dip would evolve into a sustained correction, potentially marking the beginning of a prolonged bear market. The derivatives market, often overlooked by mainstream commentary, would be a critical amplifier of the crisis. Trillions of dollars of contracts rely on assumptions of stability, predictable interest rates, and manageable volatility. A geopolitical shock of this magnitude would break those assumptions. Margin calls, forced liquidations, and counterparty defaults could cascade rapidly. Institutions that appear solvent on paper might find themselves facing massive liquidity shortages. In extreme scenarios, the failure of a major derivatives player could create a chain reaction reminiscent of the 2008 financial crisis, only accelerated by today. High-speed trading systems. Another underappreciated factor is currency instability. Investors would flock to the US dollar, gold, and other perceived safe haven assets, putting pressure on emerging market currencies. Latin American currencies, already vulnerable, would plummet in value. Governments struggling with foreign-denominated debt would find it harder to meet obligations, raising the risk of defaults or debt restructuring. The ripple effects would not be contained to Latin America. European and Asian emerging markets could experience similar capital flight, highlighting how a localized geopolitical event can have truly global consequences. Cybersecurity threats would add another layer of complexity. Venezuela has strategic partnerships with countries that possess advanced cyber capabilities. Even minor retaliatory or opportunistic cyber attacks could disrupt financial networks, trading platforms, and payment systems. Markets would react to perceived vulnerabilities, driving further volatility. A combination of geopolitical risk, cyber risk, and systemic financial stress creates a situation where conventional risk management strategies fail, leaving institutions and governments exposed. Social and political ramifications would compound the financial crisis. Mass migration from Venezuela and surrounding countries could overwhelm neighboring states, creating humanitarian crises that further strain regional economies. Rising food and energy prices could fuel unrest in multiple nations, making political risk not just a theoretical concern, but a practical one that affects trade, investment, and economic stability. Global investors tend to underestimate social unrest, but history shows it can dramatically prolong market instability. Perhaps the most profound impact is psychological. Trust in the system would erode. Investors, policymakers, and corporations rely on predictable rules and stable institutions. When a single geopolitical action demonstrates that even resource-rich countries can be plunged into chaos overnight, confidence suffers. Risk premiums rise, investment slows, and volatility becomes the new norm. Markets, once considered resilient, suddenly appear fragile. This loss of trust is not easily repaired. It can shape investment behavior, policy decisions, and market valuations for years, if not decades. It is also crucial to consider long-term restructuring. Nations and corporations may diversify supply chains away from the U.S.-dominated systems they once relied upon. Alliances may shift, creating alternative trading blocs and financial networks. While diversification reduces exposure to future shocks, it introduces inefficiencies, slows economic growth, and increases transaction costs. The post-strike world could resemble a fractured financial landscape, where capital flows are slower, more expensive, and more politically influenced than ever before. For investors and policymakers, the lesson is stark. This is not a scenario that can be ignored or hedged away easily. The combination of energy shocks, financial contagion, currency volatility, commodity disruption, cyber threats, social unrest. The effects of a U.S. strike on Venezuela would be global, persistent, and deeply structural. Traditional forecasting models would fail to capture the complexity. In conclusion, the global markets face an existential risk if military action is taken against Venezuela. The immediate spikes in oil prices and market volatility are just the tip of the iceberg. Beneath the surface lies a complex web of interconnected risks: banking crises, sovereign debt stress, currency collapses, supply chain disruptions, and geopolitical realignments. Each of these factors alone could destabilize regional markets. But combined, they create a perfect storm capable of reshaping global finance forever. The cascading effects could be felt for decades, undermining the very assumptions that allow markets to function predictably. If you found this analysis eye-opening, hit that like button and subscribe to our channel for more in-depth coverage of global finance, politics, and economic risk. The world is changing faster than most people realize. Staying informed is the first step to navigating these turbulent times.